We have a number of states that don't have any state income tax, which is something that people have to pay on top of their federal income tax. Federal alone can be up to 37%. Some of the states with the fastest population growth, like Tennessee, Florida, and Texas, don't have any state income tax. So, what I'm wondering, Tom, is are more states considering abolishing the income tax like those states have done?
We've actually seen a lot of states in the last couple of years reduce their income tax rates. So Arizona, where I live, is one of them. We went from a potential tax rate of like 8.5% to an actual tax rate of 5%. There was actually a proposal passed that would have increased it down to a tax rate of 2.5%. Our former governor, Doug Ducey, his goal was to abolish the income tax in Arizona, and we did get down to 2.5%. There are a number of states, typically in the middle of the country. You don't see any states on the coasts doing this outside of Florida that are reducing their tax rates. So you do see states doing that. You see other states that are increasing their tax rate. Recently, I was reading about Bill Belichick. He said Massachusetts is always hard getting the top earners, the top free agents into New England, because he says this is Taxachusetts, because they have a surtax on millionaires. Well, of course, all football players are millionaires. And so that is an issue. People are leaving states like California, Massachusetts, New York, New Jersey, and they're moving to low tax states such as Arizona, Texas, Florida, and the whole Southern Belt.
With Belichick having Tom Brady, it didn't matter if he couldn't bring in the best players because Tom Brady made stars out of nobodies. It seems like he could complete a pass to any no-name wide receiver or tight end for 2 decades there in New England. But can you tell us more about maybe interesting dynamics with state income tax? For example, I know that California has punitively high state income taxes, and then you have other states that have tax rate tables and some that have flat taxes. Like I think Pennsylvania has about a 3% flat income tax. Colorado's is 4.4. So can you tell us more?
Yeah, there are. So we have, the federal income tax has graduated rates. We go actually from a 0 rate to currently a 37% rate, which is not really 37% rate. It's really 41%. Because there's a 4% add-on tax that pretty much you're going to pay. So it's really over 40%. California has a graduated tax rate, but it goes up to 13%, okay? And Minnesota has a high income tax. New York has a high income tax. So Massachusetts, we're seeing high income taxes. The states that have big governments and provide lots of services have high tax rates. And so that's why we see it on the coasts. Interestingly enough, Minnesota is the liberal state in the middle of the country. Liberal states tend to have very high tax rates, and conservative states tend to have very low tax rates.
Now we have a lot of real estate investors here that have learned that the best deals are outside their home state. So that investor might be domiciled in a Minnesota, but investing in, say, Arkansas. Tell us about how the state income tax affects them.
So it's kind of like being a U.S. citizen, right? You live in the U.S., you're taxed on your worldwide income. You live in Minnesota, you're taxed on your worldwide income in Minnesota. So by virtue of where your residency is, you are taxed on all of your income. Now, you'll get a credit typically for taxes paid to another state. Well, let's say that your tax rate in your state is 10%, and then you invest in a state with a tax rate of 3%. Well, you're going to get tax credit of 3%. So you're still going to pay 7% in your state plus 3% in that state. So you're still going to pay your 10%. It's just going to be, some of that's going to go to another state, some of it's going to go to your state. But in total, your tax rate is likely to be wherever you live. That's your overall state tax rate. So I'll give you another example. Let's say that you invest in Texas. You live in Minnesota, you're going to pay Minnesota tax rates on your income, right? You get no credit because you have no tax in Texas. What's worse is, though, you have property tax in Texas, but you don't get a credit in Minnesota for your property tax paid in Texas. So you have much higher property taxes in Texas than you do in most states, right? Because every state has to raise revenue, right? And Texas has decided to do it largely on sales tax and property tax. So that means that you don't get that offset. Property taxes are pretty serious in Texas. If you're an investor in Texas, you know that property taxes are pretty serious, but you don't get any kind of benefit in Minnesota, but you still have to pick up the income in Minnesota.
In some Texas jurisdictions, property taxes can be 3% annually based on the property's value. Pretty punitive there in Texas. So Texas is a good example. That's where we have often high property tax rates, but zero state income tax. So with these other states that have zero state income tax, are they subsidizing that with property taxes or sales taxes, or in what other way are they making up that revenue?
Of course. For example, we were talking earlier about Tennessee. Tennessee doesn't have a personal income tax, but if you have your real estate owned through a limited liability company, you do have a 6% tax on the income of the LLC. So even though it's a pass-through entity, for Tennessee purposes, it's taxed. So they have all sorts of mechanisms to raise revenue. All states need revenue. Now, some states raise less revenue per capita than other states. You know, those are the states that people tend to move to, but don't forget those other taxes. I mean, sales taxes. Sales taxes can be very high, right? And you pay sales taxes, typically don't pay them on food or prescription drugs, but you typically pay them on pretty much everything else, including leasing a car. So they're going to get their money. They're going to get their money. It's just how they get their money.
You can watch this one next.